What if the biggest investment of your life is actually the most expensive lifestyle subscription you'll ever sign up for? For decades, we've been sold a fairy tale. Buy a house, build wealth, become an adult. But what if the fairy tale only works when the math works? And today, the math is broken. Today, we're tearing apart the rent is throwing money away myth and rebuilding the decision from pure numbers, not emotions. 1. The lie we memorized from childhood. We're handed a script. Renters are stuck, owners are winning. If you're still renting at 30, you feel behind. If you buy, you feel responsible. But here's the uncomfortable truth. Owning a home does not automatically mean building wealth. Sometimes it just means you upgraded from renting an apartment to renting money from a bank. 2. The silent costs. Nobody posts on Instagram. When you rent, the cost is obvious. One payment, done. When you buy, the payment looks like equity. But early in a 30-year mortgage, most of your payment is interest. You're not paying yourself. You're paying the bank for the privilege of using its money. Property taxes, maintenance, 1 to 2% of the home's value every year, insurance buying and selling fees. These are unrecoverable costs. They don't build equity. They just quietly drain your cash flow. In many cities, when you add it all up, owning costs nearly the same or more than renting. 3. The ratio that changes everything. There is one number that cuts through the noise, the price-to-rent ratio. In many cities, when you add it all up, owning costs nearly the same or more than renting. Take the price of a home and divide it by the annual rent of a similar property. Below 15, buying may make sense. Above 20, renting often wins. In many major cities, the ratio is 25, 30, even higher. At those levels, you're paying a premium to own. You're financing a massive asset while the renter is simply consuming housing at a discount. 4. The $100,000 question. Let's talk about the down payment. On a $500,000 home, 20% is $100,000. That money is now locked inside walls. It doesn't generate income. It doesn't diversify. It just sits there. If that same $100,000 were invested in diversified assets earning 7 to 10% annually, it could double roughly every decade. By buying, you're making a concentrated bet on one property in one location. That's not diversification. That's leverage plus hope. 5. Mobility is a financial asset. In a fast-changing economy, flexibility is power. A renter can move for a better opportunity in weeks. A homeowner may need months and thousands in fees. When you buy, you anchor yourself. When you rent, you buy optionality. And optionality has value, especially when the world changes fast. 6. The inflation argument. Yes, but rent goes up. True, but so do property taxes, insurance premiums, and repair costs. And if a disciplined renter invests the monthly savings, their portfolio can grow faster than rent increases. Instead of relying on one house to make you rich, you build multiple income-producing assets. 7. The real question. Buying a home is not automatically wrong. If you plan to stay long-term, value customization, and the numbers support it, it can be rational. But buying out of social pressure, buying because you're afraid of throwing money away, that's emotional investing. Closing punch. A house is a place to live. Closing punch. A house is a place to live. Wealth comes from assets that pay you. Before you sign a 30-year contract, ask yourself, am I buying freedom or am I buying a story? If this changed the way you see the dream, hit like. Subscribe for more strategies that put math above myths and help you build wealth on your terms.